Welcome to Iron Financial, the place where we forge stronger portfolios by stress testing the narratives the market throws at us. All right, today's target, Serve Robotics, ticker SERV. Now, this company is right on the bleeding edge of autonomous delivery, and after they dropped their latest earnings report, the market is completely split. We are here to cut right through that noise, to examine the company's structure, and to figure out once and for all if this stock is built of solid iron or if it's just fragile glass.
So, the company just dropped its Q4 and full year 2025 earnings. And man, the numbers are just wild on both sides of the ledger. You've got this incredible, eye-popping top-line growth that gets investors dreaming about hitting a home run. But then, on the flip side, you have losses that could sink a battleship. So the question is simple, and it's the one every single person listening needs to answer before they even think about putting a dollar to work here. Are we looking at the actual blueprint for a revolutionary new industry, or are we just watching a high-tech cash incinerator burn through its fuel at a terrifying pace?
We're going to break this whole thing down, piece by piece, and stress test it just like any other asset that comes through our shop. First, we'll set the stage. What exactly is Serve Robotics? Then, I'm going to lay out the bull case for you. The story of strength, of massive scale, and of what looks like brilliant strategic execution. And once that beautiful structure is built up, I'm going to come in and test it for any and all weaknesses. We'll look at the costs, we'll look at the margins, and we'll dig up the red flags that are buried deep in the fine print. And then finally, we'll put it all together and deliver our verdict.
Okay, let's dive right in. So, for anyone who isn't familiar with them, what's the deal with Serve Robotics? Well, they're in the last-mile logistics business. They design, they build, and they operate these little autonomous robots. You know, the ones you might see zipping down the sidewalk delivering somebody's lunch. You got to remember where they came from, too. This company has deep roots. It was actually spun off from Uber back in 2021. And now it's its own publicly traded company on the NASDAQ, ticker SERV. The whole mission, the big idea, is to replace the most expensive and inefficient part of the delivery chain, the human driver, with a slick, automated electric solution.
And that brings us to their big claim to fame, the line you'll see in all their press releases. They operate the largest fleet in the US. Yeah, largest fleet. You hear that a lot, right? And look, being the biggest sounds fantastic. But as you know, here at Iron Financial, we believe size doesn't automatically make for a sound investment. Not at all. The core idea is to completely disrupt the huge food delivery market, the world of Uber Eats and DoorDash, by offering a cheaper, greener way to do it. It's a massive, ambitious play, no doubt. But ambition and a big fleet, they don't pay the bills. Execution is what matters.
And that ambition is being hammered into reality with incredible force. This isn't just a story about a few test robots in some tech hub city anymore. This is a story about hyperscaling and aggressive, calculated expansion. So let's look at the raw materials of this growth story, starting with the headline number from their Q4 2025 earnings report, the one that has everyone talking.
390%. That's the year-over-year revenue growth for the fourth quarter. Just let that sink in for a second. We're not talking about a 10 or 20% increase here. This is the kind of explosive, warp-speed growth that defines a company in its early, high-momentum phase. It is a staggering figure that shows not just growth, but extreme acceleration. They pulled in about $0.88 million in the quarter, which brought their full-year 2025 revenue to $2.7 million, completely crushing their own guidance. This is the top-line number that the entire bull thesis is built on.
And look, this isn't just growth in a vacuum. It's not some vanity metric. This is growth that is blowing past expectations. They beat Wall Street. The Zacks consensus estimate was calling for about $0.76 million in revenue, and they came in hot at $0.88 million. That's a 16.5% surprise to the upside. In a tough market like this one, a beat like that really matters. It sends a signal that management isn't just out there making promises, they are executing. And right now, execution is absolutely everything.
And this growth is built on a physical foundation of massive operational scaling. It's not just financial engineering on a spreadsheet. This is real steel and circuits hitting the sidewalk. Get this, they went from just 57 daily active robots at the end of 2024 to 547 a year later. That is nearly a tenfold increase in the actual machinery that generates their revenue. They also announced they've deployed their 2,000th robot by the end of 2025, expanding their footprint to 20 cities, including huge metro areas like Los Angeles. And here's the crucial part. They're doing all of this while maintaining a 99.8% delivery completion rate. That's reliability at scale.
Now, this isn't just brute force scaling. It's a calculated, strategic assembly of a much larger machine. In 2025 alone, they made 4 key acquisitions to build what their CEO calls a flywheel.
They didn't just buy random companies. Each piece has a purpose. They bought Vayu Robotics for its AI foundation models, basically making their robots smarter. They bought Phantom Auto for low-latency connectivity, which improves remote operation when a robot gets stuck. They acquired Vayu for kitchen automation, and maybe most importantly, they bought Diligent Robotics. This gets them into hospital delivery, a completely new business line with established recurring revenue streams. See, they're not just building a food delivery company, they are forging a diversified, multi-vertical robotics platform.
And to fund this entire massive operation, they have a war chest. This right here is the financial bedrock they're building everything on. As of the end of 2025, SERV had $260 million in cash and marketable securities sitting on their balance sheet. This is the fuel for the fire. It gives them the runway to keep scaling aggressively, to integrate all those acquisitions, and to withstand any market volatility that comes their way. For a growth company, having this kind of liquidity is a massive strategic advantage. This is the capital that will forge their future.
Okay. A strong bedrock is great, but it's completely worthless if the structure you build on top of it is fundamentally flawed and about to collapse under its own weight. That revenue growth is impressive, I'll give you that, but you absolutely have to ask, at what cost? So now, it's time to cool this hot metal down and inspect it for the deep, deep cracks that the bulls might be overlooking.
This is the number that really matters. Forget the revenue for a second. This is the net loss for the full year of 2025, over $100 million. Let me put it another way. They generated $2.7 million in revenue for the entire year and lost over $101 million doing it. So for every single dollar of that impressive growth they brought in, they are bleeding out nearly $38 in losses. This isn't a small leak, people. It's a catastrophic hemorrhage. That $260 million war chest starts to look a whole lot smaller when you're burning through cash at this kind of rate.
And this slide right here reveals the core of the problem. This is the broken relationship between their top line and their bottom line. It's where the entire bull case starts to just fracture for me. Look closely at the fourth quarter. They brought in $882,000 in revenue. Great. But their cost of revenues, the direct cost of actually making those deliveries happen, was over $7.5 million. That means they had a gross loss of over $6.5 million. Let me be perfectly clear, this is before they paid a single engineer, before they paid a single executive, before they kept the lights on at headquarters. The fundamental act of their business is profoundly, deeply unprofitable.
Let me put that gross loss a different way for you. Their gross margin is negative 481%. No, that is not a typo. For every single dollar in revenue they get from a delivery, they are spending almost $5 just on the direct costs of that same delivery. I have to repeat that because it's the most critical crack in this entire structure. Their gross margin is negative 481%. This isn't just a company that's not yet profitable because of R&D or marketing spend. This is a company whose core business model, as it stands right now, loses a tremendous amount of money on every single transaction. That is a massive, gaping, structural flaw.
So while the bulls are out there celebrating the fact that they beat the EPS estimate by a few pennies, let's look at the actual trend. Let's look at the direction this thing is heading. The real loss per share has doubled year over year. It went from a loss of 23 cents in the fourth quarter of 2024 to a loss of 46 cents in the fourth quarter of 2025. The problem is getting worse, not better. The hole is getting deeper, not shallower, even as revenue grows. That is not the sign of a sound foundation. That is the very definition of structural fatigue under an increasing load. And whenever you see financial structures that are under this much stress, you have to start looking for other signs of impurity, other indicators that things might not be as solid as they appear on the surface. And when you dig into the fine print for Serve Robotics, there's some serious red flags popping up on the radar that any diligent investor needs to see before they even think about buying in.
Now, this isn't my opinion. This comes directly from the financial analysis site Guru Focus. The Benesch M-score is a well-regarded statistical model that uses a company's financial ratios to check for the possibility of earnings manipulation. A score below negative 2.22 suggests a company is unlikely to be a manipulator. Anything above that is a red flag. SERV's score is 51.58. That is an astronomically, unbelievably high number. Now, it doesn't prove anything, but it is a significant warning sign that suggests these financial statements warrant extreme caution and a healthy dose of skepticism.
You always have to ask yourself, what are the people who know the most about the company doing? The executives, the directors, the insiders. What are they doing with their own money? Well, the signal here is deafeningly clear. In the last 3 months, there have been zero insider buys, none. And there have been 26 insider sales. The people who are building this company,
the ones who see the internal numbers every single day, are selling their shares, not buying more. That is a clear, unambiguous, and frankly worrying signal from the inside.
And it's not just the insiders who are skeptical. A massive portion of the market is actively betting against this company. According to the data, a full quarter of the company's publicly available stock, its float, is being shorted. That means a significant number of sophisticated investors are putting huge amounts of capital on the line, betting that this stock is going down. That creates an enormous amount of pressure on the company's share price and represents a powerful vote of no confidence from the market itself.
Okay. The skeptic has laid out a powerful case, and he's not wrong. The losses are real, the cash burn is significant, those red flags are there, and they cannot be dismissed. But this is a high-growth, early-stage company, and the story is always about the future, not just the past. You don't buy a stock like this for its trailing earnings. You buy it for the blueprint of what it could become. So let's turn to their 2026 blueprint and see how they plan to forge a path to profitability. The company isn't just sitting still and burning cash. They have a clear plan. So what is it? First, they've raised their 2026 revenue guidance to approximately $26 million. That's nearly a 10x jump from 2025's $2.7 million. That's their target. The plan to get there involves 4 key pillars. They're going to keep scaling their core delivery business. They're going to integrate the new recurring revenue from their acquisitions, especially those hospital contracts from Diligent Robotics. They're also expanding platform partnerships. They're already working with both Uber Eats and DoorDash, which covers over 80% of the entire US food delivery market. And fourth, they believe that with this increased scale, they can finally drive the efficiencies needed to fix that broken gross margin. This is the heavy lifting required to forge a path out of the red and fix those fundamental cracks in their model. So, we've seen both sides of the forge. We've seen the explosive, white-hot growth being hammered into a massive fleet of robots. And we've also seen the deep, structural cracks of staggering losses and some really concerning red flags. It is time for the verdict. Is this company being forged into solid iron? Or is it fundamentally just glass, ready to shatter under the slightest pressure?
When you lay it all out like this, side by side, the conflict is just incredibly stark. This is one of the most polarized bull versus bear cases we've seen in a long time. It really is. On the one hand, you've got a company that is executing flawlessly on a massive growth and scaling strategy. They are acquiring technology, they're expanding their footprint into new verticals, and they have the cash, $260 million, to fund it. And let's be honest, the potential market for autonomous last-mile delivery is absolutely enormous. But on the other hand, the financial foundation looks incredibly weak. The cash burn is just not sustainable in the long term, and you absolutely cannot ignore the red flags around the massive insider selling, that sky-high Benish M-score, and the 25% short interest. The whole thing boils down to this. Can they achieve the scale they need to make their unit economics profitable before that $260 million in cash runs out? It's a race against time.
And ultimately, that is the question that you, the investor, must answer for yourself. Is the potential reward of getting in on the ground floor of what could be a new automated revolution worth the profound and very real structural risk we see in the financials today? Is this a machine that just needs more scale to finally work, or is the design itself fundamentally flawed from the start? That's our analysis. This is Iron Financial, reminding you to cut through the market weakness and forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.